I guess next on the list is me. And I'm going to talk a little bit about what's happening, what we're, some other work that we're doing, which is closely related to the work that Johannes was describing in looking at the performance of different ways to hedge and respond to climate risk in forming asset portfolios. What I'm really going to do is show you a couple of things that have changed in VLAB, but I'm going to focus on the climate part of what we're looking at. So let me share my screen, and I will do that. The topic I've described is what's new in VLAB, and by association in VRI, because we're doing a lot of different things, and I'm just going to show you a couple of them. A year ago, when I looked at VLAB, we saw the map of the world from a volatility point of view, almost all in red. So this is the date of our spring meeting last year, April 22nd, and this is what the map of the world looked like on that day. Obviously, we were in a very tumultuous situation because the stock markets and the currency markets all over the world were flashing red. High volatility was recorded everywhere. Today, what we see is green. The world has really changed dramatically over the last year, and what we want to talk about is what we've learned and what are some of the implications of that for climate finance. One of the things to mention while we're talking about volatility is that we're continually adding new features to VLAB, and I just thought I would note some of them as we go through this. We have a new volatility model, which is actually quite, I think, going to be interesting. It's pretty robust, and it seems to work well in lots of situations. We call it the MF2 GARCH. It's a two-factor model, one of which is an ordinary GARCH type model, and the other which is a sort of self-correcting model. If it finds its forecasts are too high in volatility or too low in volatility over time, it forms a little model of low frequency volatilities to tell you how much to adjust your forecast frequency. That's why it's called MF2. It's because it's both multi-frequency and a multiplicative factor model of GARCH. So you can now see this in all the volatility analyses and liquidity analyses. And this has been developed with Christian Conrad of the University of Heidelberg. Here's a picture of just one of the assets in VLAB, and the GARCH model is in red. The MF2 GARCH is in blue. So there are noticeable differences in how fast it comes down after an event, and then of course it spikes up, but it spikes up very quickly because it's got a GARCH model on the inside. A second thing that we've put up since last year is an analysis of geopolitical risk. Geopolitical risk we measure in a way called GeoVol, which is an index of why volatility is increasing in many asset classes and many countries at the same moment. We look at the shocks to volatility, and when these shocks to volatility are correlated across asset classes and across countries, we say this is evidence of geopolitical risk. And so we have calculated an index of these shocks, which we call GeoVol, and it can be applied to any collection of assets. So the main one we've looked at has been global equity markets. And when we look at the global equity markets, we see monthly averages of this daily series shown in red. And this can be compared with, for example, the Baker-Blumen Davis geopolitical index of global political uncertainty, the GPU index. We've plotted for comparison the first order autoregressive residuals from that, because it is really the innovation in this that we're interested in. And you see that there are a lot of similarities. It peaks up in early January of 2020 when the pandemic hits, but it has other rises over time. The main events are listed in another table, and I'm going to show you the events associated with a new presentation which has just been put up, which is using US asset class data. And in that case, the biggest event we've seen over history is the terrorist attack of 9/11, but the second biggest was actually November 9th, 2016, when the previous president was elected. Third highest is the biggest day during COVID, which was March 9th in last spring. And as you look down this list, you see a lot of familiar dates for when there were big events in the US financial sector. The assets we include in here are a bunch of different stock indices, the iShares 100 growth index, the energy sector, gold, technology, and energy sectors. These each have a loading on this geopolitical risk, which tells you how much they are going to move if we have a geopolitical event. And so one of the portfolio implications of this might be that it would be sensible to reduce your exposure to some of these sectors and increase it to others down here to reduce your exposure to geopolitical risk. And I think one of the things that's relevant for today is we see energy appearing in a couple of places high on this list. So one of the reasons why energy stocks are likely to be subject to geopolitical risk could be climate change, transition risk. So that brings us to climate risk. And what do we see when we look at climate risk? Well, we follow a collection of sustainable funds from a performance point of view. These are funds which have a climate credential, where we follow Morningstar, and I think John Hale is going to join us a little bit later today to talk about the climate work that they're doing at Morningstar. So at the moment we have 177, or actually maybe a little bit more funds in here. One of the new funds we've included is one that I'm particularly interested in, which is an ETF called KRBN, which is an ETF on emission certificates, global emission certificates. And so it's directly related to transition risk as we restrict the emission certificates and allow them their price to rise. So what do we see? When we look at the one-year alphas for all these sectors, fossil fuel-free, low carbon, low environmental risk, sustainability mandate, and sustainable sector, we see that most of them are positive over the last year. But we see most dramatically that these sector funds, which are funds that are like clean energy and so forth, they're not diversifiable funds, they're targeted to a particular sector, have been on a tear. They have almost a 15% positive alpha. But when you look further over in this table, what you see is that the alphas over longer horizons are not nearly as positive. In fact, here in the 5-year basis, they're almost all negative. And when you look at the maximum period for all of them, they're all negative. Not necessarily all the funds, but all, on average, all these categories have negative alphas. And that's not really surprising. It ties in with what Johannes was talking about, which is that these investments should be thought about as risk-reducing investments. They're reducing our exposure to climate risk. In other words, these are investments that we expect to do well if the climate turns out to be a big disaster. And so they should have a risk premium which is negative, because they are like insurance products. And so what we see is a negative effect on average, a negative alpha on average, although we see positive effects recently, and that's because there's been a lot of news about the climate, and the market, I think, is changing its assessment of how important climate risk is. That's partly what we're talking about today, a lot of repricing of assets, which does good things for these sustainable funds. But all these funds are based on some kind of ESG measures. There are lots of vendors, lots of different measures. We're going to hear a lot about this a little bit later. How do you use ESG to form a good portfolio? That was what Johannes was discussing. What are the objectives of each fund? They're all different. Can we find a factor mimicking portfolio, or a portfolio which best represents the performance of this collection of funds? We'd like to find a portfolio of these sustainable funds with weights that are probably changing over time, that mimics the new information about climate change. This is the same goal that Johannes was talking about. And if it's true that the news about climate change reflects repricing these assets, which makes them have a positive alpha, we would expect such a portfolio to have a positive alpha. So within VLAB, we can sort by a lot of different things. We can sort by a news index. I've sorted these by the tag index. We also have a cosine similarity index, and in which case, you get these top funds appearing. You can sort by Sharpe ratio, you can sort by return, volatility, or you can sort by alpha. Here in the second illustration, I've sorted by Sharpe ratio, and now we see this new carbon ETF actually comes in on the top of this 177 portfolios. It's interesting. Clean power is what all these top funds are clean power of some form or another. We actually have now implemented a new column in here, which is the information ratio, and you can sort on that too. That would be an alternative way of doing this. But what we want to do is something more systematic than that. We want to actually have an algorithm that constructs optimal kinds of portfolios. And in work with Gianluca Nard and Brian Kelly, what we're looking at is how do you minimize the variance of a composite portfolio and maximize its correlation with the climate news. So what we do is we take each fund, we regress it on some market factors, the market HML, SMB, stranded assets, and oil prices, and take the betas and the news, take the betas on the news, and use these as well as the covariance matrix of these funds to form the optimal portfolio for next month. And we hold it for a month. Here's what the data looks like on the news. Here's what the data looks like on the 177 climate ETFs. Here are the data on these factors, the market, HML, SMB, stranded assets, and oil. So this is a fairly standard finance problem. What's not standard is the way we actually construct this portfolio. It's a weighted average of these 177 indices. And this is the regression I just described. but this is the optimization. We want to minimize a weighted average of the variance of the portfolio and a weighted average of the signals, which are the betas from the pre modeling the analysis. And we use a year's data to form these betas, and we're going to maximize this kind of criteria. So it's going to depend on the weights we put on lambda 1 and lambda 2, how much weight we give to the low variance and how much weight we give to the signal. We're going to maximize this with an algorithm which restricts us to having positive weights on all the sustainable portfolios. In a way, the innovation here is being able to construct a covariance matrix of 177 assets using a year of daily returns. This is a very treacherous problem because covariance matrices are not well defined, but we're using a shrinkage estimator that our co-author has recently optimized to get a useful figure. So these, for different values of lambda, we get the highest alpha, we get or a slightly different one, we get the highest beta, which is the coefficient on the news. For another one, we get the highest partial correlation with the news series. But these are all pretty similar, and the portfolios perform pretty well for all of those. They all perform better than if we don't use the minimum variance feature, or if we use just something like an equal weighted portfolio. So what do we get? Let's take a look at this optimal beta. And I've chosen the one that has the optimal coefficient on the news. And so here, if we run the regression and we put the news into the regression, we get a t-statistic, which is really quite significant over the whole sample. And this is all out of sample stuff. In other words, each of these, every month, we're using the predicted weights to construct the portfolio. And we look at the calculation here. If we regress this on a constant plus these factors, we get an alpha, and the alpha is about 6% over the period, and it is positive. If we look at a volatility model of this portfolio, it's telling us something about the risk of climate change. This is really the risk associated with the news and whatever events are not picked up by the asset pricing features. And you can see it changes over time, but most dramatically, it's high now. If you run this model just in 2020, what you see is that the coefficient on the intercept, which is the alpha is now much bigger. And if you annualize it, it comes out to not just a 6%, but there's a 69% alpha over the last 12 months, over the year 2020. So one of the things that I think we see is that the pandemic forced us into things that climate change also wants us to do. And so this portfolio profited greatly from that experience. Over time, the number of assets increased. The number of assets with positive betas was pretty stagnant for a bulk of this period, but now toward the end, the number of assets with positive betas on the news has gone up. Is that because of the news series, or is it because of the economic environment? It's not clear, but that's just data. And when we look at the funds which are commonly in this portfolio, we see on average that the widely diversified funds on average spend some amount of time in this portfolio, not a lot of time. None of these are anything like saying that they're in this portfolio every month, but these are the top on average funds being used. And interestingly, what are the funds that are in this portfolio today? It turns out it's made up of 3 funds, a Crane Shares MSCI China Environment Fund, a famous clean energy fund, the Invesco Solar Fund, which has the great acronym of TAN, and then a battery and technology fund. So this is what this portfolio would be holding today. So I'm going to stop here. We're going to use things like this portfolio for a lot of things in VLAB, and we'll be following its performance over time. So thank you.